This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Just wanted to start off this episode by saying just really thank you. It's been most of you know that I live out here in LA, and it has been a bit of a crazy week to say the least. So I just want to thank everybody who's reached out via Twitter, X, texting, LinkedIn, all the communications. I'm just very thankful for this community and the support and whatnot. Thankfully, just wanted to give a quick update. If you follow me on Twitter, we are thankfully okay. Where we live is northeast of the main fires that are going on, which, I'm recording this right now on January 14, 2025. So it looks like things hopefully will be at an end soon. But, for those who are listening to this, and just our hearts are with everyone out here in LA. It's a rough go. And, we're just kind of going to do what we got to do to pick up the pieces and hopefully, figure out ways to continue to give back, give support, and help rebuild as soon and as quickly as possible. So, thank you all. Really do appreciate it. Actually, today's episode that we recorded this actually, I think over a month, maybe 2 months now. Previously, I've been meaning to put it out last week or even the week before, but with everything going on, it's been a little hectic to say the least. So, again, thank you all. Really do appreciate it. And, we'll go from there. We have a lot going on here in the MicroCap community. We just announced the latest issue of the Planet MicroCap Review, which we just put out, the winter 2024-2025 issue that is available on Scribed, on Substack, as well as planetmicrocap.com. There's a direct link for that one. And so if you want to go check out that, there's some great Q&As with Matthew Martin, as well as Ben Claremont and Andrew Walker, as well as Ian Cassel. And also, of course, we have our upcoming investor conference, the Planet MicroCap Showcase Vegas, taking place April 22 through 24, 2025 at the Paris Hotel and Casino in Las Vegas. If you're in microcaps, you got to be there. If you're interested in microcaps, you got to be there. The networking, the companies, we're just very excited. So registration is live. Please visit planetmicrocapshowcase.com for more information to register. See you in Vegas. Now, my guest on the show today is Conor Maguire. He's the founder and editor on Value Situations newsletter on Substack. I've always enjoyed Conor's appearances on yet another value podcast, pitching individual ideas. And I wanted to invite him on here to share more about his background, fundamental investing philosophy, what an ideal investment looks like to him, his investing framework, and more. Special situations is always fun to talk about. And in my opinion, some of my favorite conversations are had when discussing this topic, and this one with Conor definitely fits that bill in spades. And for full disclosure, we discussed a number of companies during today's podcast, and I am not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Conor Maguire. Conor, thank you for joining me today. How you doing, man?
I'm good, Robert. How are you?
Oh, we're just we're recording this on Tuesday, December 3rd, post-Thanksgiving. I worked it all off. It's gone. Turkey, everything. But otherwise, look, we're just trying to close the books on 2024 and hopefully kick off 2025. Hopefully see you in Vegas. I'm sure you've seen me post about that.
Yes, yeah.
Get you all the way from because you're based in Ireland, right?
That's right. No, Dublin, Ireland. So but no, that Vegas sounds like it should be fun.
Yeah, no, look, no pressure. If you want to join, But Connor, I kind of know you informally. I mean, we were just chatting offline how you've listened to the show for a number of years, so I appreciate that. But as also helping Andrew out over yet another Value Pod. I know your face, know your voice, very well at this point. A number of great episodes that you've done with Andrew, diving deep on a few ideas, and I always look forward to your guys' episodes. You guys really do a great job. But today I figured I'd invite you on because I wanted to kind of just in general talk about your strategy, philosophy, to showcase that for folks that aren't aware of how you see the world from an investing perspective, and get a better understanding of how you look at things. And then we'll dive deep on a couple stuff. So to start us off, Connor, when did your passion for investing begin? Let's cover everything prior to the founding of the Value Situations newsletter.
Sure. Yeah. Well, firstly, thanks for having me on the podcast. As you said, I'm kind of I've been a long time listener, so it's great to actually be on it and speak with you now. So yeah, so my background as to how I got into investing. So originally I trained as an accountant, Big Four auditing firm. Kind of that was originally my background. And then following kind of qualifying as an accountant, I kind of moved into kind of a number of different corporate finance roles, kind of investment banking, fundraising, kind of smaller scale, kind of mid-market kind of companies. And then from that, I found my way into kind of private equity. So I worked with one of the large, international US-based private equity firms, and I worked on their distressed and special situations team primarily. So kind of that's at a high level, that's kind of my arc career-wise prior to kind of going out on my own about 3 years ago, and just setting up my own kind of newsletter, publishing kind of ideas that I find interesting that kind of fit within kind of my kind of private equity kind of approach and kind of special situations background. So yeah, that's kind of at a high level. That's kind of the how I've got here.
Absolutely. So going to your background real quick, because for those who've heard Andrew's pods with you and follow you on Twitter, your focus is special sits, distressed, finding interesting opportunities there. Was that how did you was this kind of like a back was it the bass backwards way of getting into it, or was it always an area of focus in finance and investing that you're like, all right, this is interesting to me, I'm going to seek out a job here first and then go from there?
Yeah, no, it was an opportunity at the time to kind of work with the firm I joined, and it's a really great area. Distressed and special sits is a really great area to get into in terms of, I mean, you look at so many different deals and transactions across all kinds of sectors, kind of through, and kind of the firm I was at, we looked at both credit and equity type transactions. I was primarily kind of private market based, but then we did do some opportunistic public market trades as well, which it was really interesting as well. So I suppose no, I just found my way into it just through kind of how my career kind of panned out, and I suppose just having that accounting background, it was always going to be a kind of a what appealed to me most is kind of more the kind of the fundamentals based kind of approach to investing in terms of bottom up research and analysis as well, and that obviously feeds very well into kind of the private equity type approach.
Absolutely. So do you have a poster of Greenblatt in your office? I know it's blurred in the background here, but there has to be. I'm assuming there's a Greenblatt poster right next to, the "You Can Be a Stock Market Genius" poster.
No, I have the Greenblatt book up here on a shelf beside me, along with kind of a whole load of other books that I'm sure you and all your listeners are very familiar with and have read in terms of Klarman and Buffett and even the Michael Lewis books as well, Big Short, and just a whole range of books. But
yeah. No, I was just kidding. Because you're in special sits. That's like kind of the Bible on special sits at this point. So I mean, let's dive deep into philosophy. And your basically your strategy and focus, right? Got a number of special situations folks on here. I've joked a couple times that quite a few microcap investors might as well also be called special situations investors, because almost say 95.4% of them have special situation type aspects to their stories, or some catalyst driven, all that good jargon. Yeah. So love to hear your approach, your philosophy, how you think about special situations, and what you look for.
Yeah, so I mean, I suppose fundamentally, kind of I'm a value investor at heart. That's kind of fundamental based bottom up value is kind of my starting point, or my kind of main uh, I suppose philosophy, and then kind of building on that. I suppose partly from my own private equity background, just in terms of the kind of the special sits type transactions that I worked on previously, in terms of unconventional situations where there's a particular angle. In private equity investing, usually it's very much control investing, and you have control and you can kind of dictate the outcome to some extent, in terms of how you structure an investment. In public markets, obviously you have less control. But then, within, as I think about special situations, I mean, conventionally, people usually think of risk arbitrage or merger arbitrage as kind of the main kind of event driven or special sits type category. But really, there's a whole range of different types of situations where it's a post turnaround kind of restructured business, post bankruptcy exit, spin offs. I think that's a really interesting area at the moment. We went through a wave of consolidation the previous cycle, and now we're seeing kind of almost a reversal of that, in terms of kind of spin-offs, corporate breakups. That's a really interesting area at the moment that I think very much falls within the special situations category. And then you've got things like management changes, earnings inflections, even kind of things like merger situations where a couple of companies I've looked at, and one or two that I own, where they've acquired another company. It's basically transformed the business. It's a totally different business, in terms of maybe doubling the size of it, new markets, access, and so on. So there's a whole range of kind of situations that are opportunities that fall within that special situations umbrella. And I think absent owning the Mag 7 or even Nvidia over the last 12, 18 months, it's pretty hard to beat the market or to outperform. And I think special situations offer a way of generating uncorrelated returns, without having to kind of just chase momentum and follow the herd in the same 6 or 7 or 10 stocks that kind of drive 30% of the market or whatever it is.
Absolutely. Real quick, I want to talk idea generation, because I think that's one thing that, I've had issues in the past with, like, oh my gosh, where does Andrew, where does Connor, where do you guys find some of these ideas that pop up? I mean, obviously you guys have monster networks now, so there's definitely a network effect. So putting that one aside, how before you built up the network and you were looking for these various opportunities out there, what resources, where did you go, what did you screen, how did you find some of these things that then you started diving deeper and say, all right, perfect, this is kind of what I'm looking for?
Yeah, so yeah, I have a pretty good network, and I have a pretty wide readership now. That it's great. People kind of send me ideas and ask me, pick my brain on different things, but even prior to that, like, I've always liked to find my own ideas and kind of come up with original ideas or theses on different investments. And so, screening was, in the early days, screening was obviously, it's a tool that everyone uses, but I think it's kind of limited in its usefulness, especially now with kind of all the different information platforms and FinTwit and all that kind of stuff. It's kind of hard to find anything that's really interesting or original. But how I usually find my most interesting ideas are the ones that have worked particularly well so far is actually just through reading and reading widely. And that could be reading news stories. It could be reading about one company and then finding out that there's another company within its orbit or within its, competitive landscape that is doing something pretty interesting or different, or that's just been acquired another business, or there's some other angle on it. So generally is reading where I find kind of uh, my best ideas, or what I think are my most interesting ideas. I think, in terms of one, just to give an example, um, one company which I still own, have owned it for a while, covered it in the newsletter, going back, I think, towards the end of 2022, was OCI, which is a Dutch listed fertilizer business, third largest nitrogen fertilizer producer in the world at the time. So CF Industries would have been its big competitor in the US. Yara would have been the big European competitor. Um, and that was a really interesting. I actually read about that in the Wall Street Journal in terms of, at the time of the energy crisis, natural gas prices and then ammonia and fertilizer prices were spiking at that time. And I read about OCI as having a kind of a differentiated model. It was a kind of a one liner in the Wall Street Journal, and kind of just I'd been looking at other companies within that kind of complex. But that was an interesting kind of mention. I started kind of exploring that, and as I dug into it, it just became more and more interesting and totally mispriced or misunderstood. And in fairness, there was it was a complex enough business in terms of the different components within it. So that was a company I covered initially, and then a couple of months later, I think it was Jeffrey Ubben at the time. It was reported on Bloomberg that he had, I think, bought a 5% position, or his fund at the time had bought a big position, and was, pursuing management or working with management on a kind of a proposed breakup. They subsequently implemented that breakup strategy, and I think they unlocked about, as things stand today, about $11.6 billion of kind of proceeds or value on what was at the time a $5-6 billion market cap business. And that was just to give you an idea. That was just the kind of how it was one of those situations where it was a complex sum of the parts situation that some of the parts, it's often said, they don't work out, but this one was particularly interesting, and it fit within, I suppose, that kind of inflationary kind of real asset energy commodities type theme, which I think is really interesting this cycle, and which I think is become more of interest among investors as well, just as a theme. And so that's just one situation where read about it. It was a paragraph in financial media, and then it became a really, really interesting and profitable situation.
Perfect. That was a great example of some idea generation right there. So, now my next question, another theme I wanted to talk about today was, I mean, you kind of alluded to it a little bit in talking about, how OCI, ended up being a nice setup, for what you're looking for. But I mean, what if we could just break it down by part, what would you say is that ideal investment setup, and your criteria when you're looking at some of these special sets?
Yeah, so I mean, I think, well,
I'm sure it varies per situation.
I suppose something, for me to find it interesting. Well, firstly, I suppose I kind of have a framework that I suppose it has to fit into, an idea has to fit into. Firstly, in terms of valuation, so fundamentally, it needs to be undervalued, and there can be a number of reasons for that. But on a sensible kind of underwriting or appraisal of the business or the situation, it has to be undervalued. Then, and where there's upside of, typically I look for 50 to 100% upside within a kind of a 2 to 3 year time frame. Typically is kind of my kind of preferred kind of return profile. But then kind of in combination with that, in terms of valuation, where it's not PE ratio kind of superficial EPS, it's kind of looking at the enterprise value, looking at it kind of how a private equity acquirer might look at the business, some of the parts, assets, different assets, different business divisions, and so on. Really understanding the value of the entire enterprise. So kind of on valuation, that it's fundamentally undervalued with the classic kind of, I suppose, margin of safety or discount to fundamental value. It has to be really obvious or clear. And then secondly, I suppose the second leg of my framework would be, there needs to be downside protection. And a lot of times, people look at investments, not so much professionally, but just, when you see it on FinTwit and, generally, it's all about the upside, and it's all about the equity case, or, as we used to call it in my old role. But just as important, or if not more important, is downside protection. And so, I look for something where there is, really solid downside protection, whether that's through the quality of the business, or how entrenched it is in its market, whether it has pricing power, or whether it just has asset coverage in terms of just has replacement cost that's well above its current market cap, or whatever the case may be. So, where there's real solid downside protection. And then I suppose kind of marrying the valuation and the upside in terms of fundamental valuation versus the downside, where the return profile is ultimately it's asymmetric, where the upside is you know minimum kind of for me kind of three times of what I think I could lose, on a downside if I'm wrong or if I'm unlucky, or in my analysis, or in how things pan out. So kind of that's kind of the framework I approach it. And then I suppose beyond that, I suppose what makes an ideal investment, it probably needs to be a combination of a couple of things. I suppose again, undervalued, but then where there is some kind of uh, catalyst, whether that's, as I mentioned already, maybe sometime an earnings inflection, whether it's kind of a turnaround, whether there's a breakup, some kind of event or tailwind, um, whether, explicit, as in, a corporate event, or maybe, less so, whether it's the industry or the sector it's in is going through an upcycle where it's very well positioned through kind of winning new contracts or customers, or whether it's access to markets, or whatever. It could be a variety of factors. So there needs to be that kind of event or earnings tailwind, or that's clear. And then beyond that, then it doesn't need to be kind of a high quality compounder type business. Often best investments are not necessarily, don't necessarily fall within um, that criteria. It could be, as I think it was Howard Marks said, it's ultimately about value. An average business could be a great investment at the right price or the right entry value. So that's kind of, at a high level, I suppose that's kind of really how I'd approach it, in terms of it has to fit my framework. It has to have that combination of kind of, an attractive event, and whether, yeah, and ideally there'd be a number of catalysts, not just a spin-off, or but whether something going on in the industry, upcycle, or whatever. It needs to be multiple ways to win, I suppose. It's kind of maybe how to think of it.
Gotcha. All right. So next question is going to be kind of a two-parter. And it's going to be pivoting off the ideal investment question.
Yeah.
So first part is, love to hear an example of maybe one you're like, man, I just hit it right here, hit it right here, hit it right here, and that worked out great. Perfect setup. Exactly what I thought was going to happen. Boom, here we go. Did great. And then maybe one where you thought you had your thesis right. You thought you read the tea leaves right. You saw, maybe, for instance, you thought that the industry was going through an upcycle. Maybe it halted earlier than expected. Just love to hear from both sides. Yeah. One, where it worked out really well in that ideal setup. One where you thought it set up perfectly, but didn't work out, and some of the lessons learned.
Yeah, sure. So I suppose one that worked out well. This is a company that, again, I covered it in the newsletter. I still own it, and it's an Italian small cap called Sol Group, or Sol, SOL IT would be the ticker. So this was a kind of an industrial and medical gases business. So if you think about companies like large cap or mega cap equivalents, would be something like Air Products and Chemicals, or Lind, or Air Liquide in France. This is a similar business to that, but it sits at kind of the lower kind of small to mid cap kind of tier of the market. It was it's again like similar to those large cap businesses, a great business in terms of it. It was actually it's kind of a compounder. It's steadily grown earnings, revenues and earnings over a very long period of time. Very strong, stable returns on capital, pricing power. Owner managed an operated business, but no one really knew about it, and it was it had no equity analyst coverage, so it's pretty obscure, or kind of low volume. So probably not the type of situation that large institutions could get involved in. But that was that was a kind of company that came across my radar. Fundamentally, it's almost like a Buffett type business in many respects in terms of its kind of its steady growth and returns on capital and cash generation. But no one knew about it, and I suppose the special sits angle on it was at the time it was trading at about I think 7 times EBITDA, whereas all of its larger cap peers were trading at double that. And the two families that control it and have they I think they're third generation managers at this stage, second or third generation managers, and um, over the years they've been approached several times by private equity to buy out the company. They always said they weren't interested. The current generation of family, they're kind of approaching retirement age. It's not clear. It still isn't clear whether there are successors within the family that will take on the management role, in the next, call it 3 years or so. And so my thinking there was that in the absence of there being internal kind of insider managers to family kind of managers to succeed, that the likelihood is that the families would sell to private equity. It remains to be seen whether that happens. But in the meantime, uh, the company has continued to perform really well through the energy crisis period. It has, similar to kind of Lind and Air Products, it has great pricing power. It's continued to compound, and it's up, I think, about 115% or something like that since in the last 2 years. And potentially that catalyst where there's a private equity buyout down the line, that's still very plausible. It's trading at about 9 times EBITDA. So if it trades for in line with kind of publicly listed peers, there's still a couple of turns EBITDA in terms of a buyout premium to come on that. And in the meantime, it just continues to do what it does. And so I think that's a good example of kind of a name that's worked out quite well. A name that hasn't worked out quite well, and I suppose has been uh, the source of some good lessons for me, was Bayer, the German, I suppose, conglomerate. Basically it owns kind of a pharmaceutical business, consumer products business, or sorry, consumer healthcare business, and then obviously Monsanto, the previous Monsanto business, which is pretty well known and known for being probably one of the most value destructive acquisitions in history. So that was a name I looked at going back probably about 18 months ago. I kind of got in at a level where it was one of those large cap, some of the parts type situations where, again, its new CEO had come in with the thinking was that he would look to kind of shake up the business, sell off, break it up essentially, starting with the sale of the consumer healthcare business. And there'd been a couple of other um, similar kind of divestments by other consumer goods and healthcare businesses. Kenvue was one, and Haleon was the other one at the time prior to that. And my thinking was that there would be a similar kind of divestment with this. Then the other part of the business was the other kind of big catalyst was the Monsanto litigation. At the time, Bayer had won, I think, 8 or 9 successive court cases in terms of the excuse me, the legacy litigation, and it looked like finally that litigation risk had been contained and appropriately provided for. Um, and subsequent to that, so my thinking was this looks like an attractive breakup situation where it's a large blue chip stock. It had an obvious reason to, in terms of the consumer healthcare division spin off. It had a new CEO coming in with a mandate for change. Actually, I think it was Jeffrey Ubben's fund as well, had just got involved as an activist. So there was kind of, you spin off, a breakup type situation. You had an activist involved, you had a new CEO, and it looked like the litigation issue that had hung over the stock was finally kind of contained, or at least fully priced in. And as things turned out, that wasn't the case. The third division, the pharmaceutical business, that had a couple of one big failure in terms of one of its advanced pipeline drugs, kind of failed, and so the stock has tanked as a result. So that, I mean, I think I ended up selling it having been down 40%. So it kind of breached my kind of downside worst case kind of thing. And I kind of just, I had to admit to myself that I got it wrong. And, maybe litigation risk um, is kind of outside my circle of competence. So there's kind of a valuable lesson there in kind of in that particular name.
Yeah. And just to be clear, I mean, I'm assuming this is the case, but you're not a shareholder anymore.
No, sorry, no, I sold it. No, sold it. It was taking up too much, time. The return on time in terms of covering the continual disappointments. I mean, they had profit warnings and so on along the way with the drug with the pipeline drug failure and the litigation issues, and so they cut their dividend. So both in addition to the thesis clearly not working out. It was just taking up too much time, and the opportunity cost in that sense just wasn't worth it. So,
Dude.
Hands up, got it wrong, move on.
Yeah, dude, pharma is not for the faint of heart, right?
No,
It
no.
is. It is most definitely not. Quick question. I'm seeing a theme. From a number of the stocks that you've talked about in your newsletter, on Twitter X, and your interviews with Andrew. It seems like you mostly hunt in Europe. Is that intentional, or is it just
No,
most of the
no,
opportunities
it's
that?
not intentional. I mean,
You're,
the two, I suppose, jurisdictions that I focus on, that I tend to focus on is just obviously the US or North America and Europe, being the most accessible, the most liquid, and I suppose the ones I feel I understand or I'm closest to in terms of understanding. But in terms of why most of the names I've covered so far in the newsletter have been European. That's just, I suppose, a reflection of where I've kind of found value. I mean, it's well known, well established. U.S. stocks are trade at a premium, and in most cases, justifiably so. Um, but Europe. Uh, depending on where you look, and particularly UK, the UK has been an interesting market as well. I mean, it's well covered now in terms of the financial media, in terms of how it's been a kind of, I suppose, a rich hunting ground for private equity over the last 12, 18 months. And even again in the last month or two, there's been a real pickup in UK take privates. Again, I think it just, there's a lot of very good businesses, not in the tech space, which is, all the really good tech businesses are obviously in the US or listed in the US. But there's some really good industrial businesses, service businesses, kind of real economy businesses, as opposed to kind of the kind of the large cap tech, that are just left behind, overlooked, and as a result undervalued. And where public markets don't recognize the value, private markets inevitably will. Particularly when you look at rates of kind of, there's a kind of a clearer understanding of interest rate trajectory now, and so I suppose that's going to facilitate more corporate transactions again. You've got, I think, is it 4 trillion worth of private equity dry powder, so that's the most incentivized pool of capital you'll find anywhere in terms of trying to do deals. So there's that kind of wall of money that's there. In addition, supporting that, you've got, I think, private credit now as well, is that's larger than the high yield bond and the leveraged loan markets. So you've got a whole new kind of pool of capital there to fund these transactions as well. Then you've got the large corporates are a lot of them are kind of cash rich, with strong balance sheets now, and so you've got a whole you've got a large universe of potential acquirers looking to buy good assets at good values, and just Europe and the UK has tended to be a focus for a lot of those buyers. So that's just, I suppose, a reflection of the current market landscape, and kind of where valuations are at, and where opportunities are more likely to come.
For sure. So, real quick question, because I had a conversation a few months ago with a UK-based fund manager, and he was telling me that the LSE is undergoing a whole. They're looking to revamp their entire, finance. I guess public markets and just the way the rules and regulations
Yeah.
about that. Is there any truth to that? It was a little unclear.
Yes, I mean, there's a big kind of been a lot of soul searching, I suppose, in the UK and in the city of London over the last while. In terms of, I mean, it's a shrinking equity market. Companies are delisting. They're either going private or they're moving their listings to the US to get a better valuation, or where they might be listed in the UK, but the majority of their revenues are earned elsewhere or outside of Europe, even. So there's been, and as a result, a lot of the high growth companies, obviously, over the and the best performing companies over the last cycle have been US based, and even through the kind of post COVID period, the Mag 7 and so on. So the by comparison, UK and European companies aren't growing as fast, and so even among UK kind of fund managers, pension funds, and so on, they actually don't, relative to what they're historically would have held, they don't own a lot of UK listed businesses anymore. They own the companies that are growing faster and that are, I suppose, capturing all the headlines in the US. So there is a kind of, I suppose, growing calls in the UK to kind of shake up the equity market there. There's no IPOs really happening. There is, there are some kind of there's M&A, but I mean, again, that doesn't help the universe of listed equities. So, yes, I mean, I think there's all kinds of initiatives, or I suppose plans to kind of try and improve kind of the UK market, the health of the UK equity market. How that plans out, I mean, I don't know, but I mean, in terms of from my perspective, in terms of opportunities, I mean, UK companies there's a lot of listed companies that are undervalued or trading at very reasonable multiples, and where you could easily see them being taken private or acquired at big premiums. Particularly, if this soft landing is real and interest rates kind of settle down, and then that will spur kind of more corporate activity.
Absolutely. Maybe something similar to what we're seeing in Canada right now. I mean, there's a ton of takeouts there. I'm not sure if you've been seeing that as
Yeah.
well, especially in the microcap space. It's like every quality name over the last like 5 years that people like, oh, there's another one. It's gone.
Yeah.
Um,
Yeah.
so another question I have for you, and I ask this to everybody on here, and it's one of probably my favorite question to ask. And I mean, arguably you probably learned some of the most lessons that you've already talked about from the ideas that didn't work out well. You mentioned Bayer
Yeah.
earlier, but I mean, was there one investing experience maybe outside of Bayer or in addition that really changed your thought process or taught you the most lessons thus far in your career?
Well, there was a couple of really interesting public equity investments that I would have made or been involved in my old role in the private equity firm I worked with, where we were primarily private market transaction focused, but we did get involved in a number of opportunistic public equities trades that worked out quite well. And where, unlike where I'm doing it for myself or through the newsletter, which is obviously smaller scale, these were much larger scale investments. And just they you know it, one of the ideas that I suppose I worked on, that kind of I kind of look back on and think was a great case study, an interesting experience, was there was a REIT that a publicly listed office REIT at the time that was trading at a big discount to NAV, but fundamentally it was very, very attractive, very low leverage, uh, you know, very good lease covenants across its buildings. Post COVID, the type of buildings it owned and operated were very kind of future proofed to a large extent, in terms of they were high quality grade A office. They weren't the kind of secondary office stock that has been decimated in terms of values since COVID, and the kind of the remote working kind of transition. Um, this stock traded at a big discount to NAV, and it kind of I kind of felt that it was an obvious take private candidate. And sure enough, after a period of time, one of the large private equity firms did take it private. Um, but in terms of the rigor of analysis that went into that at the time, and kind of really getting into the weeds and understanding that particular REIT's portfolio building by building, um, it kind of really it was just a really good experience. And then obviously, you kind of have to put conviction behind it, and just it was, I suppose, a good case of where I really knew the company quite well, um, had a good understanding of the management team and their approach, and then kind of tying that with kind of what was going on in the market, the office market at the time, in terms of kind of the remote working trends and all the questions that threw up. Uh, that it was just, yeah, it had a number of really interesting facets, and kind of tying all that together was a really good learning experience, and also then it obviously it worked out. It worked out very well, so that was pleasing as well. Obviously, on top of that.
Very cool. All right. Well, I mean, we've hit on pretty much all my questions, so we're coming around the bend here. Final question for you: what for those that are maybe new to special sits or are interested in wanting to find out more? Obviously, you're going to direct them to subscribe to your newsletter. But what advice would you have for folks that are kind of new to special sits, wanting to dig in a little bit deeper, and what would be that advice?
Well, I suppose that the first thing I would say, two thoughts come to mind. Firstly, I suppose, things can appear optically or statistically cheap, and there's plenty of examples on any given day in the market when you can find something that looks really cheap, trades at a low multiple of whatever metric you're looking at. But obviously, the question is, why is something mispriced? And usually, if something is cheap, it's cheap for a reason, and that could be a temporary reason. It could be, a structural change in the business or the industry, or something else. But really understanding why something is mispriced in your view is really important, and having, I suppose, a real insight into why that mispricing, why it is mispriced, and why the market is wrong, because the market is the aggregate opinion and judgment of thousands upon thousands of investors. So it's a kind of it's a big claim, to state something is mispriced when you're going against the judgment of the market. So really understanding why something is mispriced, and then I suppose an extension of that is then knowing if you're wrong, and there's always a reasonable chance that you're wrong, and unforeseen things can happen, or you can just be unlucky, or whatever it is. What's your downside? I mean, I remember when interviewing in my old firm, when we were interviewing interns and junior roles and so on, and they pitch stocks or an investment case study, and it was always about the upside, but never. I don't think there was ever any consideration given to the downside. And if I'm wrong, how much can you lose? Do you get your money back? Do you lose 10%? Do you lose 20%? So really understanding downside protection and how you get comfortable that there is sufficient or reasonable downside protection there, or that the downside is worth taking for the upside. If that kind of asymmetric kind of risk return, depending on obviously on the risk criteria that you have for your portfolio or your fund or your firm or whatever you're looking at. And then I suppose one other question I think is again related is, if you're looking at something, you think it's undervalued, but you think for whatever reason or whatever catalyst that you identified that it's going to come good, or the market will recognize, or it'll re-rate, or it's going to get taken private, or whatever. There's always a question of what do I need to believe for my thesis to be right, or for my thinking. What needs to go right? What do I need to an example was back in the office REIT is that, oh, no one's ever going to work in the office again. For me to lose money on that trade, and for this to trade at perpetually at 30-40% discount to NAV, or to get liquidated at that, because I would need to believe that no one would work at the time. No one was going to work in those offices again. that the tenants were all going to break their leases or not renew. And, when you understand the nature of those tenants, for example, they're all, they might have been legal firms, professional services firms. A lot of that is in person client facing, where, the office was not dead in that instance. So understanding what you would need to believe to be wrong, as well as to be right, I suppose they're kind of, they're important questions to consider that I think you need to consider in kind of formulating an investment thesis.
I think that's a great place to end it. So, Conor, with that, where can our audience go and find more information on your newsletter as well as follow you on social media?
Yeah, so the newsletter is on Substack, and the newsletter is called Value Situations, and the web address is valuesits.substack.com. And then I'm pretty active on X or Twitter. On the handle is at Value Situations.
Very cool. Well, Conor, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
That's great. Thanks, Robert.
Thank you.